If you're looking to buy Nikola Motor stock, then please keep watching this video because we're going to look at the company's recent news, how the market has been treating the company, and what are the technicals telling us. We will also try to come up with the best trading approach given the current circumstances. As the market remains very volatile, we should always be careful about which stocks we pick, as well as their individual timing and exposure for entry and exits. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, Nikola tried to stay above water and to make sure that its stock price remains above the $1 level, which is the key prerequisite to remain on a Nasdaq exchange. Of course, companies can always declare a reverse stock split in order to reduce the number of shares in circulation so that each one is worth more, but doing so tends to backfire massively on the company itself, as the company sees this as a vote of non-confidence and may decide to cash out their positions in such a company, causing a massive sell-off following such announcements. We have seen it with the likes of Mullen that sometimes reverse stock splits are not always a solution, but a problem to the already falling knife. So, for the time being, the question is only occasionally raised in people's mind because we don't have to deal with it for the most part. There may come a point in time when this issue has to be addressed in a far more straightforward manner, and by then Nikola would have to come up with true solutions. I don't believe that the fundamentals can really save this company's fortune, but it seems like it might very well be saved by the potential change in the interest rate update and a subsequent increase in equity valuations if the interest rates actually go down. Of course, things are not always set in stone, and we still have to see how the real economy is going to react to the next Fed announcement. For the time being, the fortunes of Nikola depends on external forces, and we should be able to see more clearly in the upcoming weeks. Now, let's also take a look at the technicals. The trading volume of Nikola Motors is around 65 million shares compared to an average volume of 44 million shares. Over the past 52 weeks period, the price fluctuated between 52 cents and $3.71. The volume of shares traded tells us how many shares are being bought and sold at any given point in the market, and if there's enough liquidity to support a trading strategy. If the float is thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited too. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large as well. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap for Nikola is currently around $955 million compared to an enterprise value of $780 million. As we compare the current price to the historical price fluctuations, the stock is 8% higher than the 1-month low, 15% higher than the 3-month low, and 80% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment on where the stock price is likely going to head next, the implied volatility is 112%, compared to a historical volatility of 80%. The put-call volume ratio is currently around 510%. It is normal for many stocks to also have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is around 60,000 contracts a day versus the 30-day average of 50,000. In terms of open interest, the most recent volume of open interest is 1.6 million contracts versus the 30-day average of 1.6 million contracts. In terms of the shareholder structure, institutional shareholders own 30% of the outstanding shares. The biggest ones include Vanguard, BlackRock, and Citigroup. It's always encouraging to see some degree of participation from the institutions in a stock's equity. It offers a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it will deliver value in the long term, an important factor for any of us who consider to invest. I personally believe that a threshold should be around 25 to 30% of institutional ownership at least, so that we can put our money into a company and just put and forget. The current short interest is around 21% of the total floats, and 60% of the transactions come out from the dark pools. Usually, if the short interest is above 15% of the total volume, and a significant portion of the short volume comes out from the dark pools, this can suggest that there are institutional positions taken to short the stock, and that there would be potentials to short squeeze. So, right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. So, what I would really recommend for Nikola is to wait a bit. See if the $1 level is something that they can actually hold with confidence and then go from there. The current price is good enough for an initial entry, but more commitment needs to be supported by the market movements. It is overall a worthy position to be had for trading portfolios looking to benefit from volatility upticks. The current assumption would be that Nikola can maintain their presence on the Nasdaq as the company slowly claws back the prestige this company once had. It is currently considered to be a short-term trading position, so we must tread carefully as far as the exposure goes. I would recommend to commit up to 1% of your portfolio in Nikola.